everybody. This is Rob King, your host of the Freedom Report. We're going to jump right into today's weekly market wrap up. I'm doing this on Thursday this week because, well, we had a more important video that had to come out on Tuesday about CBDCs. I had a roundtable on that. If you guys have not watched Tuesday's video, please go do that. It's a really interesting discussion, diving deep into what are CBDCs, how do they work, what is the motivation for them, who may be controlling them, as well as some unanswered questions we don't know yet. But I thought it was a fantastic roundtable, a fantastic interview. Brought two experts on, both of which have better knowledge in certain areas than I do. So I think it's a good one for you if you're trying to get an update on central bank digital currencies. Go look at Tuesday's video. Without further ado, let's jump into the economic data as we always do. Looking at last week, leading economic indicators was down. Initial jobless claims was up. PMI for manufacturing was down. PMI for services was about even, which just means the economy is not really going anywhere. It's flatlined. And I'll go into the rest of the data points and then I'll make a comment on this in just a moment. Durable goods orders, meaning big ticket items or durable type of items that people buy, was up 9.9%. That made a little bit of a surge, which is an anomaly. It was down 6.9% last time. That could have to do with the type of goods being ordered. And that's excluding the transportation sector. It says here on the article, orders at U.S. factories for long-lasting goods, such as new cars and machinery, jumped 9.9% in July. The Commerce Department said Monday. Economists had forecast a 4% rise in orders for durable goods, products made to last at least 3 years. Orders have risen in 5 of the last 6 months. They dropped 6.9% in June on weak aircraft orders. Excluding the transportation sector, orders were up 0.2% in July after a 0.1% gain the prior month. So some big ticket or longer lasting items are going off the shelves, which is nice to see. Most of that's on credit. We'll get into that a little bit later. Consumer confidence is up slightly to a 103.3 from a 100.3. And overall, the economic data is, about even. But I want to make a comment here. A lot of times we see this economic data and it seems like it's just moving up and down within a range. But then we look at the news and the news is much worse. And that's what we're going to go over next. We're going to go to pending home sales crashed to a record low. This is off of Zero Hedge. After tumbling in April, according to the article, and rebounding modestly in June, analysts expected a continued gain in pending home sales in July, but it wasn't meant to be. Moments ago, the NAR reported that in July, pending home sales tumbled 5.5% month over month, a huge miss, and slumped 4.6% year over year. That means same month last year. A modest improvement from the 7.8% plunge in June, but also missing expectations of a negative 2% drop. So pending home sales index is basically cratering, which makes sense to me. We're going to look at quarter two GDP, gross domestic product, unexpectedly revised higher, a bizarre surge in personal consumption. Now, you're going to get this report from the government that it surged, but then we're going to get a report from retailers that personal consumption is absolutely cratering. Listen to this. Personal consumption. Just 2 hours after ultra discount retailer Dollar General reported catastrophic earnings, moments ago, Bureau of Economic Analysis decided to pull a BLS, which does the labor reports, and reported in its first revision of Q2 GDP that the U.S. actually grew much stronger than expected on an unexpected surge in personal consumption. According to the Bureau of Economic Analysis, or the BEA, the quarter two GDP for the U.S. was revised to 3% from the 2.8% advance estimate and beat estimates of 2.8% print. The number was more than double the 1.4% growth reported in quarter one GDP for the U.S. and was driven almost entirely by a surge in personal consumption, which jumped 2.9%. Contributions to percent change in real GDP is consumer spending is the most at 2%, inventory management about 0.75, business investment about 0.5. So apparently the consumers are driving this economy, except for that's not the numbers that we're getting from the rest of the economy. If you look at Dollar General, according to CNBC, an article out today, Dollar General shares crater 25% as retailer cuts outlook, blaming financially constrained customers. Dollar General missed Wall Street's expectation on the top and bottom lines, according to CNBC. The company said part of the issue is its core lower income consumers under financial pressure. but some of its problems are self-inflicted. The discounter has work to do to improve its stores and needs to better manage its inventory. They're talking about operational issues. Essentially, earnings per share is $1.70, less than the $1.79 expected. Revenue $10.21 billion, less than the $10.37 billion expected by analysts. Sales rose to $10.21 billion, up from $9.80 billion last year. But if you factor in inflation, that basically doesn't mean anything. If we look at another article, Dollar General shares plummeted by as much as 26%. And there is a quote from management, which let me scroll down and get to it. Here we go. CEO Todd Vasos acknowledged consumers are being pressured in today's environment of elevated inflation and high interest rates. Quote, while we believe that softer sales trends are partially attributable to a core customer who feels financially constrained, we know the importance of controlling what we can control. With the evolving retail and consumer landscape in mind, we are taking decisive action to further enhance our value and convenience offering, as well as in-store experience for associates and customers. I think that's where the comment came on CNBC about them needing to do better internally. And the CEO can say all he wants, but at the end of the day, it's Dollar General. What are you going to do? How much are you going to fix? Are you going to change the mix of products in the store? It's basically $1 to $4 or $5 items, give or take. I mean, what are you going to change the sign on your store? Are you going to clean it up, make it look nicer? Maybe you make some adjustments to your supply chain, cut some costs. But at the end of the day, I don't see how they can fundamentally change their business. I mean, it's a dollar store. It says here comparable sales were up 0.5%, gross margin 30% lower than 31.1 last year, year over year. Selling general administrative as a percentage of revenue went up 0.6% to 24.6. So in other words, costs went up. An operating profit, $550 million, is down 21% year over year. So even though their sales only dropped just a tad, their operating profit dropped 21% from this same time last year. So basically, it's inflation that's essentially causing them to have higher expenses, which is eating away at profits. And that inflation also raises prices. So even though they were slightly better on sales, it doesn't mean they moved more inventory. The prices will be baked into those top line numbers on sales. All right, getting back to the markets, the Dow Jones is up 452 points today, 41,543.77. As I'm reading this, dead even at noon Central Time on August 29th. The S&P is at 46 points to 56.39. The NASDAQ is up 183.74 points to 17,739.05. And the Russell 2000 small cap is up $28.87 to 22.17. As we look at the bond market, I always look for yield curve inversion as well as the overall move in interest rates on the bonds. Interest rates are up on almost all bonds except for ultra short term, 1 month and 2 month. The 2-year is 3.891% and the 10-year is 3.867. Still a yield curve inversion between those two, although the gap has shrunk quite a bit, still indicating an oncoming recession. Going to the cryptocurrency markets, Bitcoin is up $1,075 today to $60,319. Bitcoin Cash is up $5.58 to $326.87. Let's see, Litecoin is up 203 to 63.53. XRP is down to 57 cents, unchanged today, but it was at 61 when we did this last week. And there you go. The cryptocurrency complex is slightly up today overall, as the rest of the markets are up. Nothing too interesting to talk about there. There's an interesting article in the Telegraph for those who thought there was a conspiracy theory over world leaders and or influential people telling us to eat bugs for protein because of rising costs and the lack of available protein inventory due to inventory levels and surge in global population. Here comes an article from the Telegraph. Quote, the public will get the bug for eating insects under government-backed drive. Scientists hope to encourage increased consumption of meat alternatives amid fight to cut emissions from agriculture. Yes, a bug is a meat alternative. I don't know when in human history, or at least in the Western world, when we considered bugs to be a meat alternative. Nice little bit of wordplay there. According to the article, quote, a research center backed by the government in the UK will work to get insects and other meat alternatives onto supermarket shelves and make them more palatable to the public. Innovation in meat alternatives has risen in recent years amid growing recognition of the environmental impact of animal agriculture, which accounts for around 80% of greenhouse gas emissions from food production globally. Now, that's the end of the quote. That is absolute BS. CO2 has never been proven to be a greenhouse gas. And essentially, they're saying you can't use animals, so we're going to feed you bugs because of the false narrative of CO2 being a greenhouse gas. It's false on its face, and it's government going nuts and telling you what to do. Going back to the article, quote, mince, which is, if you ever had a mincemeat pie, you know what that is. It's just a smashed up mixture. Mince created from crickets harvested in Cambridge, and pet food made of chicken cultivated from egg cells are two of the products recently launched by British-based companies, which it is hoped will become more widely available. The National Alternative Protein Innovation Center, NAPIC, because, you know, we need one of those, will look at how to cut red tape and ensure food safety while also exploring ways to sell meat alternatives to shoppers from focus groups and surveys. I mean, this is absolutely insane, but they're presenting this as, oh, this is normal. Everybody get on board. From the article, Professor Anwisha Sarkar from the University of Leeds, where the research center will be based, said, we want to make alternative proteins mainstream for a more sustainable planet. So the false CO2 greenhouse gas narrative is now leading them to shoving bugs down your throat. No, thank you. It will never happen in a million years. I will not do it. I think I would rather eat roots and berries than eat bugs. It's just the way it is. All right. Moving on to the gold and silver part of the presentation. I have some interesting info for you on silver costs across the market. We'll get into that in a moment. Let's take a look at what's going on in gold futures. Well, we do gold first. Gold futures trade is a little bit low for August. I mean, August, sometimes you'll see rises in price, and that usually happens when it's low, to be honest with you. Usually low means the longs get to get in here without the massive shorting, but we're going to see some shorting. I'll get in the COT report, the Commitment of Traders report here in a moment. Just looking at the top line data, overall 521,000 contracts open at close. EFP's over to London. That is hunting for the metal in London, 2145 contracts. The clear ports here, the block trades here, and the trade after settlements are elevated numbers. And those are essentially privately negotiated or off-market negotiated trades that are put on. And that's often to capture specific price points or just to agree without going to the market in a rapidly moving market, agree with another party and put it on. Those have elevated in the last few months. And it's my hypothesis they're doing it because of the price volatility in the market, staying away from the banks or other entities moving that price around, the market makers moving that price around, and also to hunt for physical from partners who may be known to have it. Going over to settlements data just to show you that your prices at your local coin dealer and online are determined by this market and not physical trade. Here is the pricing. You can see that there is a change in pricing and the average settlement price. That effectively is your spot price. And this is where the information comes from because it comes from the banks. The banks happen to be market makers that trade on what? The exchange. I know because I've signed up for pricing alerts from one of the companies that offers an API or application programming interface. And they basically told us where the information came from. And guess what? It comes from the banking data collected from what? This market. Over to silver, a little bit elevated volumes. Overall, total volume 137,615. EFPs over looking for physical in the UK market 650. Clear ports 650. No block trades and 669 trade after settlement. So a little bit of off market brought onto off market transactions. Not a ton, and that's what we got there. Settlement data. Sorry about that. This is where the price is determined. The change column right here gives it to you down 77 cents, 29,201. That is spot price. That's why I show it. You can go look at this website and look through the data. I always show this website to lead off my gold and silver analysis just to show you where the price is, to show you what's going on in the market so you have a clear idea of who's trading what, to show you how the spot price is determined, and to get an indication of the way the market's going. This is probably my favorite chart. It's a busy eye chart. This comes from the Commodities Future Trading Commission. This is the group that regulates the markets. They collect data from all the trade participants, and they put it into a table. We're looking at silver here. As you can see, it's got all the different ones, platinum, palladium. This is the metals report. We focus on silver and gold, and the way you read it is just to look at this table. If you look down here at the bottom of the table, this piece right here, you got the percentage of open interest held by indicated number of largest traders. And if you look at the short, there is a concentrated short position. There's 8 traders. They combine for over 50% of the shorts, 52.5. And on the long side, the top 8 traders on the long side are only 24.5. So the longs are less consolidated. There are more players in that. The shorts are controlled by a much smaller group of entities. If we look at the Office of the Comptroller of the Currency Report, the U.S. government, most of these are banks. It's in their derivative report. We know that. So the banks do the shorting. And you're also going to see it up here when you get into the table details. The swap dealers are the bullion banks, and they have the largest short position. The second largest short position is usually the producer merchant category. This is offsetting the cost of those who produce and use the actual commodity. Is considered legitimate hedging. The banks have long said that they do also have customers within their customer accounts. There's housing customer accounts trading, and the customer accounts could be mining companies or other producers of the metal, although there's enough shorting here to basically cover the market. So they don't need to do a bunch of additional shorting. This is why this is mostly speculative. You also know it's mostly speculative because the positions change so much from week to week to week. If you're a producer or a merchant and you're looking at the futures market in which every 2 to 3 months, you're going to retake a new position. You're not on a week by week basis going to change your positioning. It costs money to do it. And why would you if you're just offsetting costs? If you're just offsetting your risk of the silver price going down, you're going to take a short and leave it as long as you need it, then you're going to cancel it. And as a producer, you're going to do that for multiple months and probably roll those contracts because it takes months to produce, refine, push out the silver, and get it to the market. So we know that swap dealers is mostly speculative. So looking at silver, they added 76 long contracts that would increase the price in the market, and they added 2,683 short contracts. So they're much more short than long. And if you look at the total ratio, look at these two numbers, there's 60,889 contracts short in silver and 24,307 long in silver for more than a 2-to-1 ratio. I remember earlier this year when it was dead even. That shorting helps keep the price down because it's concentrated where the largest 8 traders have 52.5% of the shorts, as you can see at the bottom of this chart. That's how you get concentrated shorting, keeping the price down. The banks do most of that. The other parties do some. This is legitimate hedging, however. The rest of it's not that big. If you look at managed money, they're about a 3-to-1 long, 39,517 contracts to 96,78 short. The other reportables, which are family offices, those types of things, are about 5-ish, almost 6-to-1 long, 24,413. So the majority of the market who are not legitimate hedgers, and you got to take them out because they're hedging the downside price risk. The miners do this. Anybody else that needs the silver, that has an interest in the silver price going down, which could affect their profits, will be here. That's legitimate hedging. So if you look at everybody in the market, the swap dealers are always the most short, and the managed money and the other reportables are typically the most long. These are the financial houses, funds, that type of thing. And these are wealthy individuals, big speculator gamblers, or those doing family offices, that type of thing. They're almost always long. They expect the price to go up. The banks are shorting. It's blatantly obvious. No other way to put it. The banks do the shorting, and they got to make money on that shorting. So they're going to do things like short covering and stuff like that to move the market. And they can do it because they own so much of the market in derivatives. And that's what affects the range of prices you will see for gold and silver in the market when you go online or to your coin dealer. This is how it all works. And if you get mad about the prices not rising, go gripe at the banks. You can tell by the positioning, it is them. All right, going to gold, here is the gold chart. Again, we're going to look at the bottom of this chart real quick. Percent of open interest held by the indicated number of largest traders. Again, the banks are 56.7% short, the top 8. The top 4 are 41.5% short. On the long side, the 8 is only 26.1% less concentrated than shorts, and only 16.8% on 4. On the top 4, less concentrated than shorts. Who's doing the shorting? Well, look at this, 305,972 contracts short. Nobody else has a short like that. The producer merchant short is almost 80,000. That's about, if you do 80 times 3, that's 240. So that's about 3.5 times more short the banks. The managed money only has 28,000 shorts and 222,000 long. So they're long by a factor of 8 to almost 9-to-1. If you look at the other reportables, they're 133,000 long to 35,000 short. That's about a 3-to-1 ratio long. The producer merchant legitimate hedges are more short, but there's a reason why. It's insurance for them on the price as they get it out of the ground. What you have here is almost a 6-to-1 ratio, short to long, by the banks. So if you don't think the gold price is high enough, guess who you go gripe about? It's the banks. Why? Because it determines the prices as you see on the settlement, because here's where the prices are. This report is telling you who's doing what on this market. This report is telling you who's doing what on this market. The prices are determined by who? When they're going down, or the downside pressure by who? The swap dealers, who are the bullion banks, which you can see down here in the chart. Very simple. That's how it works. All right. Last piece of the gold and silver, I want to pull up a nice little chart on a video that Steve San Angelo or SRS Rocco did on silverseek.com. Fully recommend silverseek.com. Fully recommend Steve San Angelo's reporting. He does a really good job. He's done a lot in the past on energy costs in gold and silver, charting on gold and silver, lots of things. And this particular part of the report, I've just paused it here on a silver price cost chart. Now, I told you recently that another analyst put out, I believe it was Don Dirt of goldstockdata.com, who analyzes something like 500 mining stocks in detail on his website. And it's if you go to his website and do a subscription, you can get that. You can see his review of all the mining stock companies he covers, and you can see data points for each one. Ton of data in there. And he reanalyzes them once every year, sometimes more, but mostly once every year. He put out over Twitter a couple of weeks ago, I put it on the program, that gold cost to get out of the ground was up to $18.50. And silver, I forgot, but I thought it was like maybe $24, $25.50. I don't remember. Steve San Angelo, who does this chart, looks at net income and other financial data from a group of mining stocks and put his together. And he's saying silver costs $26 to get it out of the ground. So it's more than it was the last couple of years. We thought it was somewhere between 20 and 23, 24. He's saying 26. So both Don Dirt of Gold Stock Data and Steve from SRS Rocco are telling us that silver costs to get it out of the ground are going up. And he's saying it's $26 at this point in time. And these little red boxes of costs are his calculations at certain points in time. This chart goes back to 74. It's basically a 50-year chart. He's telling us what the cost was. And he says the silver price bounces off of the cost most of the time, meaning the silver price is not going to go likely below $26 anytime soon. That is very true in gold, because most of the primary gold miners will go offline if the price stays below, the market price stays below the cost of mine gold for any length of time. And I did a report on that a few years ago for Seeking Alpha, I believe, where I did a written report, and I looked at that for like 40 years, and that's consistent last 40 years. Steve, SRS Rocco, is telling us that silver tends to do the same thing. It tends to bounce off that cost. He also mentions in his article, let's see if we can read it here. Oh, here we go. The cost to produce silver, let me blow this up so you guys can read it along with. The cost to produce silver by the leading primary mining companies hit a new record in Q2 2024. He just does the leading ones. I don't think he does quite as many as Gold Stock Data does, Don Dirt, but I think he does enough, and the numbers are very similar between the two analysts. He says even the second largest silver producer in the world, copper miner 𝙁𝙍𝙀𝙀 Polska Miedz, reported dismal 6% profit margin. Now listen to his next point. Without the nearly $600 million in silver revenues from that copper mine, because silver is a byproduct of copper, without the $600 million in silver revenues, a byproduct of copper mining, 𝙁𝙍𝙀𝙀 Polska would have suffered a loss. So the idea that base metal mining industry giving its byproduct silver away for free or a low price died many years ago. I still think many secondary miners do this, but it depends on their mix of silver to whatever they're mining. Let's say 20% of everything that they mine is silver. That's going to have a huge impact on the silver price on their bottom line. And so, yes, they're definitely paying attention to that, and it may affect their mining schedule, how much they're putting out. If it's only 3 to 5%, they're probably not going to care. They're just going to take whatever they can get from the silver, sell it. So even though 72% or 72% of silver is produced as a byproduct of other mines like copper and gold and lead and zinc and tin and those types of things, those are the typical ones. Even though that's the case, almost 3/4 of silver is a byproduct. Where the mine has a significant portion of total production from silver, even though it's less than their main product, it can affect their balance sheet. And that does reflect in the ability of silver to balance off its cost. Now, we have seen silver in the past, especially the last 5 years, many, many times the market price for silver determined by the derivative market, which I showed you at the beginning of the gold report and the silver report, the cost to mine has been above the average price for some length of time. We saw it for almost a year after COVID, and it made it very hard for primary silver miners to make a profit, and they shut down production. And I've talked to countless CEOs where this has happened. There have been times at which silver the market price falls below the cost of mine for the primary silver miners and stays there, and it does cause havoc in the silver market. Steve is saying, however, over the long term, it does bounce off. So in other words, don't expect the price of silver to drop below 26 bucks anytime soon or stay there for very long. And that gives you a bottom price. I think, it will probably go up given geopolitical and other economic fundamentals in the market. But it's good to kind of see his research and see what went on there. Thanks to Steve for putting that together and publishing it on silverseek.com. I did a short one today, guys, heading into the Labor Day weekend. I hope you guys have a good long weekend. We'll have some more data out next week that we'll take a look at. Of course, we'll look at gold and silver again. Hope you guys appreciated this report. I'm going to go ahead and call it a day, get prepared for my weekend. Hope you guys thoroughly enjoy it. Thanks for tuning in. This has been your weekly market wrap for the Freedom Report and your host, Rob Kientz.